Something fundamental just shifted in how the financial system operates, and most people don't realize it happened yet. That's not hyperbole, it's structural. The Federal Reserve made a policy change on December 1st that set off a chain reaction, and we're watching the consequences unfold in real time right now. If you clicked on this video, you sense that something was off about recent market movements. You were right. By the end of this, you will understand the exact mechanism that's driving it, and why it changes how you should think about asset allocation for the next 18 months. The scale of what's happening is unusual. We're talking about trillions of dollars entering the financial system through multiple channels simultaneously, not over a decade, over the next 12 to 18 months. The common mistake people make is treating this as normal volatility. They see headlines about Fed policy and assume it's noise. It isn't. The second mistake is thinking this is temporary. It isn't that either. There's a structural reason why this has to happen, and once you understand the reason, the direction becomes almost inevitable. We'll get there. First, let me walk you through what actually changed and when. On December 1st, 2025, the Federal Reserve ended quantitative tightening. For the previous 3 years, since June of 2022, they had been removing money from the financial system. They drained $2.4 trillion from their balance sheet. That process stopped. On December 10th, they announced a reserve management purchases, a technical term that means buying treasury bills to pump liquidity back into the system. On December 12th, they started with $40 billion in purchases in the first month alone. By December 31st, they executed the largest single day cash injection in recent memory. When you look at the overall trajectory of Fed activity over the next 12 to 18 months, the scale of money printing is going to be measured in the trillions of dollars, not hundreds of billions. Trillions. Why does this happen? There are four structural reasons, and understanding all four of them is essential because together they explain why this isn't a choice for the Fed, it's a requirement. The first reason is the debt structure itself. The United States government has $38 trillion in national debt. Every single day, old bonds mature. The government doesn't have the cash to pay them back, so it has to issue new bonds and borrow more to cover annual deficits. The Congressional Budget Office projects these deficits will remain above 6% of GDP. That's over $1 trillion per year in new borrowing that has to happen year after year. Here's the problem that creates: there isn't an infinite pool of foreign governments and foreign investors willing to lend to the United States at any price. At some point, there aren't enough buyers for all that government debt. When that happens, someone has to absorb it. The Federal Reserve steps in, they print money and buy the treasury bonds that nobody else wants. This isn't optional. If the government cannot fund itself, the entire financial system destabilizes. The Fed has no choice but to print. The second structural pressure is interest payments. In 2024, the government paid over $1 trillion just in interest on existing debt, not to build infrastructure, not to fund programs, just interest. The 2025 numbers aren't final, but they're likely similar or higher. Now, consider what happens as old bonds mature. Bonds issued when rates were near zero are rolling off the books. They get replaced with new bonds issued at today's higher rates. Interest payments will continue climbing. The only way to reduce pressure on interest payments is to cut the federal funds rate and bring down overall borrowing costs. To cut rates effectively without crashing financial conditions, the Fed has to add liquidity to the system. More liquidity means more money printing. This connects to the third structural issue, and this is where it gets more complex. Japan is the largest foreign holder of US Treasury debt. For decades, Japan kept interest rates near zero or negative. That created an opportunity for global investors. They borrowed money in Japanese yen at essentially 0%, converted it to dollars, and invested in US stocks and bonds. It was risk free money. Borrow at zero, earn 7 to 10%, keep the difference. Estimates suggest this carry trade involved between 250 and $500 billion flowing into US markets. Some analysis suggest it was substantially larger. Either way, that inflow of capital helped fuel the bull market for many years. But Japanese inflation is now significant. Their central bank has started raising rates. They just hiked to 0.75%, the highest level since 1995. Their 10-year bond yields hit 25-year highs. When Japanese rates rise and US rates fall, the mathematics of that carry trade inverts. It stops working, and when it stops working, that capital doesn't stay in US markets. It flows back to Japan. Here's where this becomes systemic. If Japanese investors start selling US treasuries to repatriate capital, that creates a massive problem for the US government's ability to fund itself. It's another situation where demand for treasury debt drops, And we already know what happens then. The Fed steps in. They have standing swap lines with the Bank of Japan. In a crisis, the Fed can pump unlimited dollars to Japan to stabilize the situation. They did exactly this in 2020, pumping $470 billion through those lines. If the carry trade unwind creates stress, the Fed will print money to prevent a global financial meltdown. Let this one sit for a moment because it reveals something important about how the system actually works. The fourth structural pressure is political. There's been a clear stated preference for lower interest rates. A 1% federal funds rate has been mentioned as the target. That's close to pandemic levels, some of the lowest rates in history. The current Fed chair's term expires in May 2026. The selection of the next chair will effectively determine whether that preference translates into policy. This isn't guaranteed, but the direction of pressure is clear. When you add all four of these together, $1 trillion annual deficits, exploding interest payments, potential stress in the treasury market from Japan, and political pressure for rate cuts, the Fed's options narrow significantly. They have to fund massive government borrowing, they have to backstop the treasury market if demand drops, they have to respond to any potential crisis that emerges from Japan's carry trade unwinding, and they have to maintain financial stability. In all of those scenarios, the solution is the same: print money. Hold on to this framework because it explains the mechanism, but understanding why the money printing happens is still not the core insight. There's a distinction that most people miss. When the Federal Reserve prints money, it doesn't sit in some vault, it flows into the financial system. Banks receive more liquidity, interest rates decline, hedge funds, investment banks, asset managers, the large institutional actors, they access that cheap money and deploy it. Where do they deploy it? Primarily into assets, stocks, bonds, real estate. More money seeking assets means higher prices for those assets. This is mechanical, it's not about sentiment or fundamentals improving, it's about the quantity of money growing faster than the quantity of assets. That's the first flood channel, and it would be powerful on its own. But there's a second channel opening. Multiple sources have announced major investment commitments flowing into the United States over the next several years. The stated figures reach into the trillions of dollars. These commitments are directed toward artificial intelligence infrastructure, data centers, domestic manufacturing, energy infrastructure, and defense related projects. Alongside private investment, the government itself is directly acquiring stakes in strategic companies, companies deemed critical to national infrastructure or national security. This is creating a dual dynamic. The Fed is printing money into the financial system. Simultaneously, trillions of dollars in capital is being allocated to specific sectors and projects. Both flows move in the same direction, both are bullish for assets. But here's what's important to understand: this still isn't the complete picture, because while this is happening, there's something else you need to grasp about how institutional money actually behaves under these conditions. Most investors frame this situation as the Fed will print, so stocks will go up. That's not wrong, but it's incomplete. It's treating the conclusion like it's the main point. It's not. The main point is structural. Here's the incomplete version first. Yes, the Fed is printing. Yes, that creates liquidity. Yes, that flows into assets. And yes, that supports prices. It feels like the takeaway, but this still isn't the most important part because this is addressing the wrong question. The real question isn't whether assets will rise. The real question is what happens to the purchasing power of cash itself under a sustained money printing regime. And that's where the framework shifts. When the Federal Reserve is creating trillions of dollars in new money over an 18-month window, they're not protecting the value of the dollar. They can't. You cannot simultaneously expand the money supply at that rate and preserve currency value. That's not how it works. The Fed has explicitly stated they will do everything in their power to prevent financial assets from collapsing. They will print unlimited money to prevent systemic meltdowns. They will maintain liquidity at any cost. What they will not protect is the purchasing power of cash sitting in money market funds or savings accounts. This distinction matters because it reframes how you should think about asset allocation. If you're holding dollars expecting assets to collapse, you're making a bet that contradicts what the institution in charge of the system has already committed to doing. The Fed won't let the system collapse to a degree that destabilizes everything. The Fed will, however, erode the value of dollars in the process of preventing that collapse. This is not a prediction, it's a structural inevitability given the constraints they're operating within. The insight that ties everything together is this: in a period where the Fed is managing debt through money creation, staying in cash isn't a hedge, it's the opposite. Cash becomes the asset that loses purchasing power most reliably, not dramatically on a day to day basis. The noise will still be there, But structurally, over the 18-month window we're discussing, the institutions managing the system have committed to an action plan that requires the expansion of money supply at a scale that reduces cash value. That's not opinion, that's the mechanism they've put in place. The framing many people use is I want to stay in cash because I'm waiting for a crash. That framing misunderstands what the Fed has committed to doing. The Fed has committed to preventing crashes by printing money. They won't let the system collapse, because if the system collapses, everything collapses, including the currency itself. So the actual trade-off isn't between stocks and cash based on whether a crash happens. The trade-off is between maintaining exposure to assets that the Fed is actively supporting through liquidity injections, or holding cash that the Fed is implicitly devaluing through those same liquidity injections. One benefits from the policy, one gets eroded by it. This doesn't mean stocks won't be volatile, they absolutely will be. There will be drawdowns, there will be periods of weakness, but those are noise around a structural trend that's already been set in motion. The trend isn't based on optimism about future earnings, it's based on the mechanism of money creation and how that money flows through the financial system. Over the past 100 plus years, assets have appreciated in nominal terms. That's not because the world got better at creating value every single year without fail. It's because the monetary base expanded faster than the supply of assets. That's the mechanism that's been operating for a century. Right now, that mechanism is accelerating, it's not changing direction, it's being turbocharged. That's the structural reality you're operating within for the next 18 months. The way to position for that reality is straightforward. You maintain exposure to assets, you don't try to time the noise, you recognize that the Fed has already committed to the policy that will protect asset prices at the cost of cash value. That's not a theory, it's what they've laid out. That's the mechanism that's now running, and that's why the direction is almost inevitable, even though the path will be volatile.